Netflix is currently trading at $1,104.50 per share, up about 0.59% in intraday trading today, November 10, 2025. The stock has been oscillating in a fairly tight range today, moving between a low of $1,087 and a high near $1,108, all on pretty standard volume of about 4.4 million shares. Now, the big headline, the one that everyone is talking about, is that today is the official record date for Netflix's 10-for-1 stock split. This is the event that has been building anticipation for weeks. But here is the immediate insight that you need to grasp, the one that gets lost in the noise. Just in the past week, leading up to this very record date, regulatory filings show that top executives, including the chief financial officer, the chief legal officer, and both co-CEOs, have been selling off blocks of their shares. Let's really dig into this because this is the perfect example of the tension between market expectation and the underlying reality. The common belief, the narrative you will see pushed everywhere, is that this 10-for-1 stock split, which will start trading on a split-adjusted basis on November 17th, is an overwhelmingly positive event. The expectation is that by taking an $1,100 stock and turning it into a $110 stock, it suddenly becomes more accessible to the average retail investor. It makes buying call options cheaper, it brings in a new wave of ownership, and it signals management's confidence in future growth. This is the story the market wants to believe, and it's why the stock has been a hot topic on forums and social media. But this is where we have to challenge that narrative with a dose of reality. The first reality is that a stock split is fundamentally a cosmetic event. It is like taking a $20 bill and exchanging it for two $10 bills. It changes nothing about the company's $467 billion market cap, its revenue, its profits, or its intrinsic value. The second and more pointed reality is that some analysts, like those at Morningstar, are actively warning that the stock is already significantly overvalued, trading at a 45% premium to their fair value estimate. They have stated, quite bluntly, that they believe the stock should ultimately trade lower based on these fundamentals. So we have this perfect conflict: retail excitement and the market celebrating a cosmetic split, while seasoned analysts are pointing to a high valuation and, perhaps most tellingly, insiders are quietly trimming their positions at these elevated prices. What's your take on this 10-for-1 split? Is it just a cosmetic change, or will it genuinely bring in a new wave of buyers? Let's look at the recent trading action that got us here. The stock split was announced back on October 30th, and that news has largely dictated the trading pattern for the last couple of weeks. But just before that, the company reported its third-quarter earnings. This is where things get interesting. Netflix actually missed analyst expectations on earnings per share, reporting $5.87 versus a forecast of nearly $7. The company attributed this miss to a one-off, unexpected tax issue in Brazil, essentially asking the market to ignore it, and the market did. Revenue for the quarter met expectations at $11.51 billion, and the stock actually rose slightly after the report. This tells us that investors are laser-focused on the growth story and are willing to forgive a messy quarter as long as the core narrative remains intact. That core narrative is all about the ad-supported tier. Management has confirmed that this cheaper tier is a runaway success, accounting for more than half of all new sign-ups in the countries where it's available. Analysts are now projecting that this ad revenue stream could double in 2025 alone. This is why when you look at the institutional activity, you see that Netflix is overwhelmingly a core holding. Over 5,000 institutions have filed as owners, holding the vast majority of the company's shares. This is not a fringe stock. It's a blue-chip tech giant. Vanguard, BlackRock, State Street, all the heavy hitters are deeply invested. This institutional bedrock is what provides the stock's stability. It's also why the short-selling activity on this name is almost non-existent. I know many investors are conditioned to look for the next big short squeeze, especially in a popular, high-priced name like Netflix. So let's look at the data. This is a critical piece of the puzzle. According to the most recent official data from the Nasdaq, the total short interest in Netflix is just over 6 million shares. That sounds like a big number, until you realize it represents only 1.44% of the entire public float. This is incredibly low. For context, a heavily shorted stock might see a short interest of 20%, 30%, or even higher. Furthermore, the days to cover, which measures how long it would take all short sellers to buy back their shares, is just 2.9. Anything under 3 is considered very low. What this data tells us, definitively, is that there is no significant coordinated bet against Netflix. The bearish case is not an aggressive short attack. It's a quiet, fundamental argument about valuation. The borrow fee rate to short the stock is low, and there is no powder keg waiting to explode. This is an actionable insight for every investor. You can find this data yourself by looking up the short interest for any stock on the NASDAQ website. When you see a low short percent afloat, like 1.44%, and a low days to cover, like 2.9, it means the stock is not a viable short squeeze candidate. The risk of chasing a squeeze that isn't there, based on social media hype, is that you are simply buying into an already overvalued stock just as others are taking profits. It is essential to separate the data from the drama. Given this data, what's your take on the rising short interest? Smart money or manipulation? In this case, it's neither. It's just statistical noise. So if Netflix is not a short seller target, what is the actual bull versus bear debate? It comes down to the business model and its future. For years, Netflix was a simple one-product company, subscription streaming. That model has now fundamentally changed. The company has successfully pivoted and created multiple new pillars of growth. First was the password-sharing crackdown, which, despite initial outrage, successfully converted millions of borrowers into paying subscribers. Second is the ad tier, which we've discussed, a low-cost entry point that is driving massive user growth and opening up a multi-billion-dollar new revenue stream. And third is the expansion into new categories. Netflix is no longer just about on-demand movies and shows. It is aggressively moving into live sports, securing rights to NFL games and blockbuster boxing matches, and it is also building out a substantial gaming division with over 100 mobile games now available and plans to bring them to smart TVs. The company that shut down its iconic Red Envelope DVD service in 2013 has fully transformed into a diversified media and entertainment conglomerate. This is the company's new reality. It is a much more complex and potentially much larger business than it was 5 years ago. This is why Wall Street remains, on average, very bullish. The consensus analyst rating is a buy, with 80% of analysts recommending it as either a buy or a strong buy. The average 12-month price target sits up around $1,347. Looking further out, analysts expect the company's earnings per share to grow robustly, potentially hitting over $32 per share in 2026. This is the bullish expectation, a company that has proven its ability to innovate and find new growth, justifying its high price-to-earnings ratio, which currently sits at 47. The future outlook, then, is a direct clash between these two forces. The primary catalyst for the bulls is the continued, successful scaling of that ad-supported business. If they can double that revenue next year, as many expect, it will provide a massive boost to the bottom line. Add in a hit new live sports contract or a breakout success in a video game, and you have a recipe for continued momentum. The stock split itself will provide a small short-term lift when split-adjusted trading begins on November 17th, simply from the psychological effect and new options activity. The risks, however, are just as clear. The biggest risk is the one Morningstar identified: valuation. At a PE of 47, Netflix is priced for perfection. Any sign of a slowdown in ad revenue or weaker than expected growth in international markets like the Asia-Pacific or Latin American regions, which have shown some softness, could cause a sharp, painful correction. And the backdrop of macroeconomic uncertainty and fierce competition from Disney, Amazon, and others never goes away. And of course, there is the lingering question of those insider sales. We see execs selling shares right before the split record date. Is this just routine compensation, or does it make you more cautious? Comment below. So as we wrap this up, the story of Netflix today is really not about the 10-for-1 stock split. That is the headline, but it's not the substance. The expectation is that this split is a doorway for a new flood of retail money. The reality is that it's a cosmetic change to a stock that is already priced at a significant premium, a premium that has prompted some of its own top executives to take some chips off the table. The true battle is about whether Netflix's new ventures in advertising, sports, and gaming can generate enough new profit to justify a $467 billion valuation. The reality is that the short sellers are not attacking this stock, and the institutional support is massive. The expectation is for continued dominance, but the reality is that at this price, the company cannot afford to make a single misstep.